Tuesday, August 30th, 2022, Monaco 64, home of alternative economics and contrarian views. So will Jay Powell be able to engineer a soft landing for the economy, for the financial markets? Will he be able to normalize everything and not have a major accident, not have a major recession or depression for that matter? Well, I'll leave it up to you to decide that. I personally think his chances are very slim, and I think we will have a major event, and a pivot will be needed. Or even if he doesn't pivot and he does bring a major deflationary collapse, we're going to see what happens if that were to be so. So I'm just going to show you a few charts today, and then one of the tweets I read yesterday from someone that's quite popular in the gold bug circles on Twitter, and then we'll go to the markets. So here you have the Fed funds rate target set by the Fed, 62-year historical chart. It doesn't go back as far as the Great Depression, but during the Great Depression as well, or just in the run up to the 1929 crash, the Federal Reserve started raising rates, and they raised rates up until I think 1931-32, and real rates were like 8% at that time. And yes, that caused a great deflationary recession, a real deflationary recession, where the money supply shrunk, where consumer prices were actually dropping by 25%, or maybe a little less, but unemployment was 25%. And then they had to revalue the price of gold to reinflate the system. That's in a deflationary recession. And when they did that, they put a little bit of a boost behind the economy, commodity markets as well. Commodity markets did very well in the 30s because they reflated it by raising the price of gold from $20.67 per troy ounce to $35. But back to this chart, you can see that every time the Fed goes on a rising cycle, we get recessions, which are the gray bars. There's very little exceptions here, maybe except for the mid-90s, when there was a major bond bear market in 94 because the Fed raised rates from the end of 93 to around the beginning of 95. There was a major accident, of course. Bankers Trust, I think, almost went bust. You had Orange County in California going bankrupt because of derivatives exposure. But you can see that the Fed, after that, reversed their rate hikes. And then they raised them again. And you had the dot-com bubble burst. And they cut it almost down to around 1. I think Greenspan cut it. And then they started raising again, and you had the 08-09 crisis. They started raising rates from around 2016, and you had a major crisis in 2019, the repo crisis. Many people don't consider that a crisis, but I think that's what led to the March 2020 collapse, and they used COVID as a cover to really inflate the market, to boost the market, because they don't like deflations, because they're bankers. When there's deflation, currency contracts, there's no lending, and bankers usually go bankrupt. So now, and you can see it's a very narrow depression there, the last great accident. They didn't let it happen because they pumped so much money and credit into the system. And also fiscal policy into the system. And now, as you can see, they're raising rates, and they're going to keep raising rates. And they're going through the long-term trend line. And we're expected to think that everything is going to be smooth sailing. So that's Up to you to decide, I think, whether you think that will happen. And just before we go on to the tweet I told you about, have a look at the Fed's balance sheet. It's gone from under $1 trillion back in just before the '08 crisis. We're now, we almost got up to $9 trillion. It's coming off a little bit, but do you really think things will be okay if they cut it back down to, I don't know, 4 or 5 trillion, which is where it was before the 2019 crisis started? It was just below, I think, 4 or around 4. I don't think they will be able to do that without causing major problems. And don't forget, Bernanke told Ron Paul back in aftermath of the '08 crisis, when he was testifying in Congress, that they'd be able very quickly to get the balance sheet back to $1 trillion. And here we are 14 years later, and we are almost at 10 trillion. So here's what David Brady said yesterday. His global pro trader, he's got 66,000 followers on Twitter. I think he's from Canada. He's originally from the UK. He said, once you realize that the Fed ultimately wants to inflate away the debt at the expense of the dollar, and at the expense of the public as well, I would say, you won't need to watch the daily moves in gold and silver. You know that a Fed 180 is inevitable. The alternative is total systemic collapse. Precious metals would outperform then too. Of course it would, because a systemic collapse would destroy fiat currency. And the only money that would be left would be gold and silver. And a little bit like in the 1930s. So that's where we are right now. And yes, we do follow the price of gold and silver because that's something we've done historically on the channel. And it's something that I've done for the last 20 years, mainly because I worked in the financial markets. I watch prices every day, and it's something I like to do. But he's right. You don't need to worry about the fiat price, even though we look at it. So with that, let's quickly look at the markets. It's 8:30 a.m. London time. We got spot gold at 1731. It's down about 6. High's been 1741 and the low 1729. Silver is at 1870. It's down about 3 cents. High's been 1884, low 1863. The Dow futures is up 0.5% or 150 points. NASDAQ 100 future is up 0.75% or 92 points. S&P is up 23 points, just over 0.5%. The FTSE index is up 1.2% at 7480. Eurostoxx 50 is up 0.7% at 3600. To the currencies, sterling is unchanged, 117.12. The euro is unchanged as well, trading just around par actually. Well, it's actually just below here, 99.97. The dollar is down slightly versus the yen, 138.59. Dollar is up 1/3 versus the Swiss franc, 97.10. And the dollar is up 0.1 versus the yuan at 692. The dollar is down 1.5% versus the ruble at 60.80. Aussie dollar is up 0.25%, 69.18. The dollar is down 0.1 versus the loonie, just below 130. And the Kiwi dollar is up, well, actually it's unchanged at 61.54. To the general commodities, we're seeing crude oil continue to rebound. WTI is almost back up to 100. It's at 96.83. It's up 0.25%. Brent crude is at 102.88. It's unchanged. High-grade copper is down 0.5% at 359. Natural gas U.S. nat gas is down 1.2% at 922. And the Dutch natural gas futures or the European natural gas is up 1%. It's trading around 275, so it has come off from the all-time highs. And now we're going to look at the bond market. We're going to look first at the UK bond market because yesterday that market was closed, but we saw European yields go up quite significantly across the board. They came off a little bit at the end of the day, and yields going up in the bond market is not a good thing. It means bonds are being sold, prices are going down, and yields are actually an indicator of where interest rates are going to go. So if yields are rising, it means interest rates are going to rise. And I spoke about the 10-year gilt yield, the fact that 270 was a very key level. Well, this morning it's at 273. It's up almost 13 basis points. We have to see whether they can keep control of that 10-year yield. I'm sure they'll try very hard, the Bank of England and the UK Treasury. They'll do whatever it takes to keep it under control, but who knows? They might lose control. Back to the U.S. Treasury market. Well, the 10-year yield is down slightly, 1 basis point, around 309. And the 2-year yield is up 1 basis point at 344. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great rest of the day. Take care. Bye.